Also, just a reminder for you, the closing date for the exam application is 15th of October, 15th of this month. So basically, IBSL has made a request. If you have not applied yet, please do it before that date. Right? I think your exam will be on most probably by end of October, right? By end of October. So basically, 15th August is the last day of applying the exam. So basically, if you have not applied, do it, right? That's a request from IBSL. And we have been discussing with regard to the issue management, some instruments. We have completed studying of treasury bills and treasury bonds. Also, we have concluded the only thing we'll have to consider the dirty price, clean price, and all those and two concepts. Other than that, we have finished, and also we have discussed the most important thing, that is the debenture and the difference between debenture, treasury bonds, and when the interest rate at higher level, when the interest rate at increasing level, when the interest rate at decreasing level, which instrument we are going to select. Obviously, when the interest rate are on the rise in future, so basically we go for the variable. We think from the investor side. If you think from the investor side, your money will be invested. So then you need basically the higher rate than the present. So then if the interest rate in the future is going up, obviously I like to take that advantage. If you want to take the advantage of in the future interest rate going up, future interest rate increase. So what do? You will have to change it when the interest rate is upward. So for you to change, then there should be a variable. So if it is fixed, you can't. Fixed is fixed, or the constant, whatever the agreed period. So if you have applied, if you have invested your money in variable rate, obviously think from the investor side. I'm talking about the investor side here only, right? And then you will be benefited by the increase of interest rate. So that's another thing. An examiner type of question also we have discussed. When the two instruments are there, when the interest rates are on the rise or on the downside, so basically what instrument you go for. So that kind of examination question also we discuss little. But when you have the real paper with us, basically we will be touching some uh, question papers with you in the future. Once we complete this, so basically then we will have a kind of knowledge what kind of question examiner test under this particular syllabus. So we will be taking that one. Don't worry about it. Same question, right? Same syllabus content is tested for the entire 2014 onwards exam papers. So then don't worry about it. Only thing you have to concentrate what we are learning, what you are teaching here. So the more than enough for you to pass this exam. Now, only thing the factor you have to keep in mind, your exam has advanced a little. So then we might lose some sessions. So basically, IBSL wants us to cover with additional classes. So I will see whether is it necessary for me to take additional classes. If it is so, I will definitely take it before in advance, right? So rather than waiting until the last moment, I thought of take, if it is so, I will rearrange the syllabus content. So what are the things will be missing? So basically, I will advance it and I will adjust accordingly the coverage of the syllabus. Don't worry about the coverage of the syllabus. Only thing, you apply for the exam before 15th of this month, and with confidence you can sit for the exam, right? So we'll have to discuss the past paper as well. So we'll be doing that one. Some selected question papers. So we'll be taking that as well, right? So last week we have discussed the prospectus, the contents of the prospectus. Remember, HMB oversubscribed the debenture, and now you know what are the things, difference between debenture and the treasury bond. So who has issued, who will be issuing this particular instrument, why the purpose of this issuing this particular instrument, what is our role. So basically, they are working, they are in investment banking division. Basically, you undertake this, you structure this particular debenture, you only decide the pricing, right? So for the investor it's an income. For the investor, it's an income, but the issuer, it's expense, right? What do you mean that? If we issue a debenture, if we issue we take treasury bond, who has to pay it? If it is treasury bill, treasury bond, government has to pay it. Government has to pay. So that is the cost of the government. So the government needs to take whatever the amount at a lower interest rate. Understood? So the central bank will take whatever the lower interest rate bids. So that's why central bank at the auction select the lower interest rate sending over, right? First you select the lowest one. Then if you want more money, then go to the little higher one, like that. How to make it select correct. So that why they are selecting like that? That is their expense. Central bank has to pay whatever the amount, if it is treasury bill, whatever the amount after the maturity date. If it is a treasury bond, they'll have to make the payment of coupon. Now see, now you know why treasury bill I have not discussed, I have not mentioned about the coupon. Treasury bill does not have the coupon, but treasury bond, yes, you have coupon. And debenture also the similar. When you're working in the investment banking division, you decide to issue. So the investor income, but the issuer expense. So you have to consider that as well. But only thing, now when you issue a debenture, you can predict the price. You can actually tell that price. Why? Treasury bills are auction based, but the debenture is not auction based. If it is an auction, you can put your own bids. Treasury bonds are not like that. Treasury debentures are not like that. When you issue a debenture, you specifically say 10 rupees or 12 rupees. So the investor knows, I'll have to invest, I'll have to take whatever the amount at 12. But treasury bonds are not like that. Treasury bonds basically auction based. I'm talking about the primary market, right? Primary market between whom? Primary dealer and the Central Bank of Sri Lanka. So that is primary market. Secondary market, of course, that is already issued. You can take it, you can purchase it. But debenture, the primary market price is fixed. Fixed in the sense price is there. So the interest rate may be fixed or variable. That's a difference, right? Fixed or variable. Now tell me, examiner can ask this kind of question now. Issuer decided to issue with all these stories. The final question is this. Now, issuer has decided to issue this particular debt instrument. Now, debt instrument we have learned, particular debt instrument, one of the debt instrument we have learned, debenture. So, the issuer has decided to issue this debt instrument at fixed interest rate. So, then examiner will give you the story. So, the question is asking, do you agree? 5 marks question. But I told you the 7, 8 questions are text type question, only the story will there, but the question and nothing, question and answer is nothing. So essence of the question is this. Debt instrument will be decided to issue at fixed rate by the issuer. Do you agree with all these instruments? So do you agree? So it depends. It depends. when the interest rate in the future you think will go up, then you go for it. Now here, think from the investor, think from the issuer side, right? When in the future interest rate tend to go up, you as a issuer, that is your cost. You'll have to pay. Why? You are issuer. Do you want to pay more interest or less interest? You as issuer, obviously you want to pay low interest, less interest. That is your cost. You want to you want to have a reduction of your cost. So then if the interest rate in the future is on the trend of going up, obviously you as an issuer, you will be issuing the instrument at fixed rate. Why? If you issue it at 10% now, constant, unchanged for whatever the agreed term is, say 5 years, constant. Variable in the sense, every 6 months, every 3 months, every 1 year, it depends on your choice. Reset, interest rate is reset. So that when the interest rate at that time at the higher, so you will have to pay more. So then obviously, see, these are the types of question examiner tests. Nothing. But only thing, students are not answering very much these questions. I'm recommending you to will be taking these questions. You will understand how easy these type of questions are. Now these are the question examiner tests. Now you have a fair knowledge of answering this kind of questions depending on the interest rate. Now that's why I told you the reality of around you, the reality what's happening around you in Sri Lanka or around the world is needed for you to answer this kind of question. So then if you know that presently interest rate the scenario has a lower interest rate, but treasury bill we can see every week we can see a slight increase, basis point, 1 basis point increase, basis point, 2 basis point increase. So the tendency is interest rate to go up in the future, not in the near future, but in times to come, there will be a interest rate hike. So then we are facing of that. So the people like now, see now if you take it, now people like to invest at a the longer tenor or shorter tenor. Sometimes if you feel it, in the future interest rates tend to go up, obviously you will be investing your money at a shorter period, 3 months. So you invest 3 months and see if the interest rate goes up, so I will take the advantage of it, right? Like that. So these are the type of question examiner tests you around on the interest rate and the instrument. They are coupled with the instrument as well. So you decide which rate, you decide which rate, which percentage, which rate, right? So that's very important. And also I will discuss when you invest in government security, when you invest in fixed income securities. Now see, income is fixed. Even you issue at variable rate, your income, we take it as a whole fixed income securities. Treasury bill, treasury bond, debentures are fixed income securities. Fixed income. Income is constant, fixed. Whatever the amount you are getting, right? As coupon, whatever, right? Like that. Fixed income security. Now, investors like interest rate to come down when you have more investments in government securities or the fixed income securities. So why? Understand the relationship price and yield. So that is also important. And I want to tell you, so remember that we have been discussing a particular SLDB instrument, advertisement, and see this one. Now, recent advertisement which I gave it to you, I'll show you that as well. This is the latest one. Now see the date. 30th June 2021. Now we have another one, 31st July as well. This is the previous one. We had a 31st December, 31st July as well. It is open now. Now these days it will be closed. I think next week. Now this is the previously held one. Now see the interest rate, fixed rate arrangement only. 2021. Now see this one, 2020 July, the last year, right? Not this year, 2020. When the central bank issued SLDB auction notice, they had floating rate as well. Now they don't have. They had floating rate as well. But the rupee instrument, you don't have when the government issues rupee instrument. What are the government issuing rupee instruments? What are they? Treasury bill and treasury bond. They don't have variable. But SLDB, you have 2020 floating rate as well. Now tell me why the government has decided not to issue floating rate now. Now this is another. This is the previous one. This is 2020. 21. They don't have floating. Why? So when you issue now, say same thing we discussed. You are issuer. You don't want to issue fixed. You don't want to issue variable. Here. Same thing we discussed. Why don't you want to issue floating? You as issuer. You don't like your cost to go up. So you think that in the future interest rate is going to increase. You think in the future interest rate is going to increase. So then to protect me as issuer, I will be not touching anything on variable. Now see 6-month LIBOR. 6-month LIBOR. LIBOR means London Interbank Offer Rate. Generally for the foreign currency transactions, we take LIBOR as a reference rate. LIBOR as a reference rate. When you are now in your bank, when you are lending in dollars, you take LIBOR if it is variable, if it is not fixed, or its successor US dollar margin through comparative bidding 1 year and 1 month and these other tenors. What do you mean by this? Its successor. Now we told you in 2022 LIBOR is going to be scrapped. The LIBOR is no more there. There are some different Sonia, SOFA, like different rates coming into the play, into the scene. So then LIBOR will be scrapped. But presently, you're having the LIBOR for the lending and whatever the deployment or the dollar deployment or the dollar investment. Actually, if it is variable, right? Now these days also when you are lending in dollars, you can quote LIBOR plus rate. That is variable. Now what I want to tell you, in 2020 government had the floating interest rate also released. Now 2021 you don't have the floating. The one thing is in the exam ask you same question will not be tested, but he will ask the overall common question, why the issuer has decided not to issue variable. That's the question he can ask. Why you are not issuing floating? Why you are not issuing? Issuing means that issuer has the cost. Issuer has to bear the cost. So think from the issuer side. Okay. When you answer the question for the issuer side, it's completely different from the investor side. You as an investor, you like to have more interest rate, higher interest rate. So then your intention is completely different, right? So depending on the question, you can answer, right? Other than that, everything is similar, option based, right? So basically, understand this one. This is important, right? And also, I will keep for the moment this particular dirty price. We have done this, and I will also give a kind of knowledge on you. Now, treasury bond, you have dirty price claim. Now, what do you mean by yield to maturity? Yield to maturity means the market interest rate. What do you mean by that market interest rate? Now, in treasury bonds, you have coupon interest rate. Remember, we discussed. Now, this is the added we have given to you, and here the coupon is 6.3. 6.3 is the coupon. So every 6 months, you are getting 6.3% per annum on the face value. Generally, for 1 unit face value is 100. 15 November you are getting 1. 15 May you are getting 1. 15 May and 15 November you are getting 1. On the face value at 6.3%, that is annual. So the half of it you are getting every 6 months. So then what do you mean by yield to maturity? Is that a coupon rate? No. That is not the coupon rate. Yield to maturity means the market interest rate. Now, when you put bids for this particular instrument, how much you put? What is the percentage you need? That is the required rate of return. So then you think that if I want to invest in this particular instrument, I am expecting 15%. 15%. Now see this. Remember that with this required rate of return, you are expecting 22% for you to invest in this particular. You are expecting 20% return. That is your expectation. But can anybody say this is the market rate? I am expecting to invest my money at 20. Somebody should be there to give me whatever the instrument he has at this rate. If somebody is there, fine. Transaction is concluded. හැබැයි මම ඉල්ලන රේට් එක දෙන්න හැමෝම කැමතිද? I don't think so. I don't think so. කවුරුත් කැමති නැහැ ලොස් එකට දෙන්න. එතකොට මේ ඉන්ස්ට්‍රුමන්ට් එක සාමාන්‍යයෙන් මට දෙන්නේ 20% I'm investing and I want to have 20%. හැබැයි මේක කෙනෙක් මට දෙන්න නම් මේක දැන් rent already purchase කරපු කෙනෙක් මට දෙන්න නම්, if you can think hypothetically, how much he must have invested, what is the rate he must have invested in this particular instrument for me to give at 20%? Must have invested at a higher rate. Why? Price and the yield. If you have invested, now see, you are going to purchase this particular one, you need to have 20%. You are going to take it from me. I am going to sell it to you. I am sell a particular instrument. Where expectation is how much? 20%. I am willing to sell you. So I am ask you, what is your expectation? You say 20%. So do you want to me now? You want to me whether I will be selling it to you. So I'm calculating now. Can I sell this particular treasury bond or the debenture at 20% interest. Now here in Sri Lanka, we are going by the percentage, right? Pricing up, we are taking pricing. So I'm with my team, I have accountant. Now I'm asking my accountant, you calculate. Now he's asking this particular instrument at 20%. Can we sell this? Because the accountant, I will like, an answer. You can sell it. You have invested this particular instrument 2 years ago, 3 years ago, 25%. 25% will invest कर now he is asking at 20%. So we are better off. We are gaining a capital gain. Why? Price and yield. Without calculating, 20% I have taken. Now he is asking 20%. When the yield comes down, my price should go up. So you are selling it. You as a seller, you will be selling it to you. Why? I am making profit. I have invested this in this particular instrument at 25%. Irrespective of the tenant, I make 25% selling at 20% is okay for me. I am making profit. Which profit? Capital gain. How do you decide? Based on the price and the yield. Right? So then that is that transaction done. Why? Market is sometimes now see now even if I invest at 25%, I can sell it, right? I'm making profit. 20%, rates come down, price goes up, I'm off to withdraw. Now before I give it to you, I'm just checking the market as well. There is a secondary market, there are brokers. Then in a particular instrument market treasury bond මේ අවුරුදු 4කින් මේ මැචුර් වෙන එකක් තියෙනවා. සාමාන්‍යයෙන් කියලා මාකට් එකේ යන්නේ කියලා මට කියන්න කියලා you are telling to one of the brokers. So එයා කියනවා සර් මේක යනන් යන්නේ මාකට් එකේ 18කට විතර යන්නේ කියලා. So then that is your choice. Even you sell at 20%, you are making profit. But the market is 18. If you can sell at 18%, you are far better. 25% invest करो तो 18% विकुना more price should be little higher than 20%, right? Price yield එක අඩු වෙන price එක වැඩි වෙනවා. That's the relation we have learned. 20% වලට 18% වල price එක වැඩි. නිකමට අහනවා, would you like to purchase? No, I can't sell you at 20%. Market is going at 18%. Would you like to have it at 18%? Then you decide whether you will be taking at 18% or 20%. Now, why your money? You as the investor, your money will be invested at 18% if you take it at 18. Now here you want for the return 20%. Then you decide. So the market rate and the expected rate may be different. Market 20%, your rate and the market rate is similar, but just the coupon rate similar. It is not necessarily, but it can be. 16% market again, that's one way. With the coupon rate and the yield rate, market rate is similar. About hammer this and no. Understand this, right? Coupon rate and the yield rate is different. Coupon and the yield rate is different. Coupon and the yield rate is different. It can be similar. Can't it be similar? Of course, figures can be similar as well. Don't worry. Right? So these are the question exam test, right? So basically, now see this. IoT. So now that is yield to maturity, the market interest rate, and the other one is you have coupon rate is obviously now coupon rate and the yield to maturity is different, right? That's what I want to tell you. Now understand this properly, right? Now see, I will give you before we move into this one, clean price and the dirty price. So we will take it up later. then you will visualize it. Examiner has not tested this dirty price and clean price so far, right? Only thing he has given some questions, not that. Now understand this relationship. That is also another relationship we want to tell you. What do you mean by this? Now intrinsic value, this is the examination question. The examiner was examiner was testing intrinsic value of a particular. Intrinsic value means the true value. The true value at the value breaker. Now, if the true value is higher than the market value, true value is higher than the market value, do you purchase or do you ignore? There is an instrument. Market එකේ යන්නේ රුපියල් 100ට. Now take a classic example shares. John Keel shares එක දැන්ට trade වෙන්නේ රුපියල් 100 example වලට. රුපියල් 100. හැබැයි ඇත්තටම මේ share එකේ valuation එක when you calculate the based on the profit and all those things, it's worth 200 rupees. Do you buy? Obviously, you will be buying. Why? Thinking that you can sell it, this particular John Keel share at 200 rupees. There is a 100 rupee. There is a 100 rupee difference in favor of you. Thinking that if the interest rate goes up, the price goes up, you will be benefited. You will be benefited. Okay. You will be benefited. For you to purchase any particular instrument, it has a value of potential value to go up. 200 යන හින්දානේ ගත්තේ. 200ක් ඇත්තටම value එක වටිනවා. නමුත් දැන් මොනවා හරි දෙයක් ප්‍රශ්නයක් නිසා market is at a lower level, whatever, it's trading at 100. But there is a potential value. Then better to purchase. Generally, you are purchasing any instrument if it is undervalued. Market is going true value of the particular John Keel share 200. Now the market is going at 300. Do you buy? Generally, you don't. Why? Trading at a higher rate than the true value, intrinsic value. ඇත්තටම වටින්නේ මේ ෂෙයාර් එක 200. නමුත් දැන් මාකට් එකේ යනවා 300. There is no value. So you don't take it. Overvalue. You don't purchase. Why? True value is lesser than the market value. True value is lesser than the market. So basically understand in that way. See the relationship. Intrinsic value and the market value. This is common to the government security as well. The previous question we discussed. You need to have 20%. But actually market is going at 18%. And the actual market, now, the market price is maybe true value sometimes, right? So there may be manipulation of the market rate. There may be market rate manipulation as well. So the market rate and the true value, which is intrinsic value, has relationship. So you think like it. So I am purchasing anything, I am investing in any instrument if this particular instrument is undervalued. There is a potential for me to sell it. There is a potential for me to earn profit. So then I invest. Then I purchase, which is undervalued. So the intrinsic value has to be more than the market value, then only you purchase, right? Intrinsic value is a true value. I understand also this as well. Yield and the required rate of return. The required rate of return means your return. You need. You need. The question the previous discussed 20%. You need. But is that the market rate? Maybe not. Sometimes yes, sometimes yes, but generally you need to have more than the market. That's the reality. Né? Banks are now banks publishing their interest rate for FDs, but you are asking more from banks. Huh? 1 year deposit if it is 5%, what I make put that particular you are asking. Give me nothing. So every bank has 5%, but you are asking, you as investor, you are asking little more. Your requirement is little higher than the market generally. Your requirement is little higher than the market generally. If it is more than the market, then your requirement, market is trading at a very good attractive rate, but I am asking less. Then I have a potential to go there. My market is anyway. Market demand and supply, based on the demand and supply, market is doing something very good. But I am asking, I am satisfied. The market is going at 20%, but I don't want that return. I am okay with 8%. At least if I have 8%, I am okay. But the market is where it's going up 20%. Do you invest? Of course. If the required rate return, if the market yield is more than the required rate of return, you will be investing. Why? Anything you invest, meaning it is undervalued. And I also understand this particular relationship as well. And now we discussed treasury bills and treasury bonds are government securities which are risk-free. Risk-free. There is no risk. Which risk is not there? Counterparty risk. In other words, default risk. Counterparty risk is not there. The government, we presumption that government is not defaulting. Government is not defaulting. Credit risk is not there. Default risk is not there. Same thing. Huh? Counterparty risk is not there. So the which so we are taking treasury bond as risk-free rate. But does it mean that all these other risks are also free? No. So what are the other risks you have? Now see, interest rate risk. Now examiner has tested very recently the risk management part as well from you. Risk management part as well. Right? So only what do you mean by interest rate risk? Interest rate risk means you invest at 10%, example 3 months today, but after 3 months you need to reinvest. Why did you invest for 3 months? Thinking that interest rate will go up after 3 months. That's not a normal thing. Thinking that after 3 months time there will be a rate hike. So but unfortunately interest rates further come down. The higher the investor 3 months will invest under 8%. So then your money has to be invested at 8%. Are you making losses? So you are not making losses, but your exposure is open now. Which exposure? Interest rate risk. Your income will come down by 2%. Interest rate risk is that. Reinvestment is same thing. So then if you can't reinvest at the same rate which you discussed now, that is reinvestment. Now reinvestment risk is also there with regard to the government securities. Why? Somebody has to purchase. So you invested in 3 months treasury bill. After 3 months time, it will be credited to your account. Now again you are searching treasury bill for you to buy, but there is nobody. Can be, right? It won't happen, but it will not happen. But there are many people who are asking low return. සාමාන්‍යයෙන් සෙල්ලා කැමති වෙන්නේ රේට් එක ගත්තාම පල්ලෙහාන් සෙල් කරන්නේ. රේට් එක ගත්තාම. But you need to invest at 10%. But there is a seller, same instrument, which is interested by you. He needs to sell at 5%. If it is government securities, sellers like to sell at lower yield. So I'm going by the yield basis, right? So if I say yield, then you will be hypothetically should think that okay, if it is lower means yield lower means price go up. Lower yield means price goes up. So then anything you purchase, you can sell it at a higher price, you're better off, right? So the reinvestment risk is anyway there. Inflation risk is anyway. Now see, you will be learning, I'll be giving a note on this. Now treasury bill rate is after adjustment of inflation. Treasury bill rates are after adjustment of inflation. Now see what is the inflation now in Sri Lanka? Inflation is basically 6%, 6.10% CPI. But the treasury bill 1-year rate goes at 5.28. So basically you are carrying a negative return. Or there are the two types, CCPI, Colombo Price Index, and the national NCPI. So one is 550, if I'm not mistaken, the interest, the inflation. The other one is 610. So basically you are virtually almost similar break even. You don't have a return by investing in treasury bonds, treasury bills. But comparatively, you are investing in treasury bills than the FDs are your better. While the treasury bill rates have gone up than the FD rates now. 1-year FD rates. I don't know which rate your bank gives, but generally banks give 1-year treasury. 1-year FD rate 5%. You can have a little special interest rate, but the treasury bill rate at 5.28. The market, the weighted average, right? Putting on a period aduin thamai hambeni. I invest from the secondary market, right? The primary dealer also has to keep some margin. Now you know weighted average interest rate if it is 5.28. So you will be investing 1-year treasury bill at 5.25. Then you will not ask from the primary dealer, I may pay central bank publish color. I may pay. No, you will not ask why. They like to sell at low yield. Why they need to make profit? They are institutions. They have profit motive. Weighted average you will have to put bid on yourself. Can you put bids? You are not a primary dealer. So then you will ask, oh, how do I put bids at the auction? I'm not a primary dealer. Now you have learned this. Since you are a student, you will ask, I'm not a primary dealer. But again, you know that if it is 5 million, you have more than You can give this 5 million to primary dealer and ask them to put bid on behalf of you. If you are purchasing below 5 million, of course, you don't have any option. You will have to purchase whatever the price, whatever the yield they tell you. So then you can, we have 10 primary dealers, and then you can go one by one. Who will be giving the more? Then you can select that, but otherwise you'll have to take it. But they will never give you same rate. At least 1 feet below. I don't know, it depends. Right? සමහර වෙලාවට ස්පෙෂල් බිල් බොන්ඩ් එකේ cut off rate එක ඕක වුණාට sometimes private dealers must have invested at a little higher rate 5.30 5.30 වගේ, then you can give it to at 5.28, better off 2 pips 0.2%, 0.02. So that is right. So they will never give you at a break even or a loss. So definitely anything you will be getting which they have invested at a higher yield. So why? Price and the yield relationship. They want to make profit. Obviously they'll have to do it like that. Okay, understood. Now reinvestment risk, inflation risk, interest rate risk, and also the liquidity risk, which is not there, right? The additional liquidity risk is also there. If somebody, you want to sell it, but there is nobody to buy, but there is a guy to buy, but a very lower price, then you have to sell it at the very lower price, which you incur loss. Liquidity risk is also there. Right? There is nobody to purchase. Sometimes, particularly when there are instruments, treasury bonds especially, those instruments are not tradable. Oh, these instruments are not tradable. Tradable in this, there are no buyers to purchase. There are instruments like that. ඕනම දෙයක් ගත්තාම සමහර items අපිට විකුණ ගන්න පුළුවන්, සමහර අපිට විකුණ ගන්න බෑ. People are not interested. Same thing here as well. Sometimes there are bonds issued by the government of Sri Lanka which are not much dealable. People are not interested to purchase. People are not interested to invest. If you have investment in this particular instrument, then you will not be able to sell at your discretion. There may be losses also incurred. Okay. And only the missing part is this, the dirty price and clean price. So I'll be taking up later since we have discussed this. And also I want to tell you with regard to this particular which is not uploaded. I have I don't know whether it is uploaded, but I have sent this last night only. Since we have discussed relating to the matters with regard to the risks, I thought of complete this part as well. Now see this one. This is also important, but examiner has not tested this. Only thing this might be needed for us when we are doing the next topic, which is project appraisal. But these two risks only I will discuss. Now see these two risks. Now we have discussed several risks: reinvestment risk, interest rate risk, liquidity risk, like that. Right? Now this is another type of risk. This is another type of risk: systematic risk and unsystematic risk. And there's another type of will be learning later with the questions: business risk and the financial risk. I also discussed the same thing here as well. Systematic risk is basically risk which is common to everybody. Which is common to everybody. It's common to you. It's common to me. It's common to this guy, everybody. But unsystematic risk is which is not common, which is uncommon. It is unique to you only. It is unique to me only. Now take an example. If you take interest rate of a country, lower regime of interest rate, anything, it is common to you as now. It is common to you, common to me as well. If you are investing in treasury bills, you will have to purchase at weighted average rate. Say now, hypothetically, we say private dealers are willing to give at 5.28, which is the weighted average, latest weighted average 1. They will give you 1 year treasury bill at 5.28 to you. They will give you the same to me as well. Why? This is common to everybody. You can't avoid it. Inflation, interest rate, you can't avoid it. But unsystematic risk, you can avoid. It is why it is unique to me only. මට ඒ රිස්ක් එක තිබ්බා කියලා ඔයාට ඒ රිස්ක් එක නැහැ. නැති වෙන්න පුළුවන්. So the systematic risk cannot be diversified. That's the word I need to tell you. Systematic risk. This risk also known as the market risk, which is not diversifiable. So you can see this, right? Diversifiable. This is not diversifiable. Why? You can't diversify. Can't. Unsystematic risk you can diversify. Through what? Diversify you through what? Diversification. Unsystematic group you can avoid by diversification. Now take an example of shares. If you have if you have money for you to invest in shares, you will be investing one portion of your amount in hotel sector, one portion of your amount in hospital sector, one portion of your amount in diversified sector, one portion of your amount in the our manufacturing sector. Right? So what do you do this? Don't put all eggs into one basket. Diversify it. The hotel sector collapse. Since you have made investment in other sectors, you are better off like that. Like that. So you can have that. So basically, you can only thing you have to keep in mind: unsystematic risk can be avoided through diversification. This CAPM and all this will be coming later when we are doing this project appraisal, right? So we can take it later. Remember that, right? That is the important one. All right. So this is the first suit we have discussed. I just finish it off. Only thing we will be actually completing this government security discussion except field files and dirty files. Shares, then we are moving to this one, preference shares we have discussed. Only thing shares we touched a little. I finish it off now. IPO, that's okay. And sometimes you can read this. There are things for you to read. These are only readable. Market capitalization only. Now see, now basically anything you need to ask on government security side. Last week I showed it to prospector as well, right? Exchange prospector. So generally, then when you are issuing a prospector, when they want to issue 7 billion debenture. This is the press article they have put it. Oversubscribed also we discussed, and also the terms also we discussed. Basel 3 is what compliant listed debenture. Oversubscribed also we discussed. And remember the 5-year debenture, this part also we discussed. Examiner can test your knowledge based on these only. 5-year debenture offered 12.3 payable annually, and a 7-year fixed instrument 12.8. Now, whereas today you invest two types of into those days. Today you will be issuing particular one at 950. When the interest rates have come down, obviously you'll have to go for that. But I will take it. I need to particular one I have to this I will take since we have discussed this government securities. It is available in your tutor. I think we have discussed a little this. Now see, with regard to the HNB debenture, so now they have previously issued, I think some time ago, 2 to 3 years ago, rate was 12.3, 12.8. Remember that I have uploaded that paper article to you as well. This one. HNB had Basel III compliance of 10 billion in September 2019. The two types of issue was oversubscribed. That issue also oversubscribed more than the requirement. If the examiner asks you for 2-mark question, what do you mean by oversubscription? More than the required. The 5-year debenture offered. These are the two types. 5-year debenture at 1230, payable annually. Since this is a private bank debenture, similarly, treasury bond has same features almost, but the interest rate may be at your discretion. Treasury bonds 6 months, but here annually. 7-year fixed instrument at payable annual 1280. Now today you are issuing at 950. Now my question is, 5-year debenture, 2019 issue करे. I think we have discussed, and again I am telling you, issued 2019, 5 year ඉවර වෙන කවද්ද? 2000 2024. People who have invested in 2019 September is still getting, people who have invested, right? Invested, still getting at 5-year debenture. 12 මාර්ගාන you are getting annually. Very good investment. But in 2019, did we have an intention? Did we have a clue? Did we have a view that 2020, 2021, similar type of instrument, when this bank issuing a similar type of instrument, they will issue at 950? Did we have any intention? අපිට හිතුණාද 2019 සැප්තැම්බර් වෙනකොට 2021 දී මේ බැංකුව මේ වගේ ටයිප් එකේ 5 year debenture issue කරයි කියලා 950 නෑ එහෙම හිතුණා නම් I would have invested more if I had money. Getting 1230 1 year is very good investment now based on the percentage. People who have invested in this particular, people who have invested now, not the issuer, people who have invested are very much happy. But you are going to invest now. Are you happy? You're also happy, but not at the same level. You as an investor, you are not happy compared to the people who have invested in 2019 September. And again, there's another part who is unhappy. Who is that? Issuer, HNB Bank. HNB is not happy. Why? They'll have to 5 year anagama, they'll have to make the coupon payment at 12:30. You can't avoid it. You have agreed to pay. Now, now you are issuing how much? 4% below. Now you are issuing at 950. 3%. 3% below. Dolah Mara give Dolah Tia give then given you an amount. Pulantara, you like to pay lower. So you can't help. Why? You have agreed, people have invested, you pay. But remember, there is an option for you to weigh out. Very rare, but there is an option for you to weigh out. Option is this. Option is this. Bonds issued or debenture issued. Embedded option. Convertible bonds we have discussed last week. Basel 3 debentures you can convert into shares. Now what do you mean by next one? Callable bonds. When the HNB issuing their debenture in 2019 September, if they have added a clause, callable bonds, they can get rid of this particular interest rate downturn. What do you mean by that? Callable means that issuer has the right to redeem prematurely. Who will be in trouble? Investor. Take the same example, 2019 they issued 5-year debenture at 12:30. Now they can issue the same instrument at 9:50. Now you think, why should I pay another 2 years at 12:30? If I can retire, you're better off. If you have put a clause, callable option, then you will be recalling the amount you have issued. Issuer has the right to redeem premature. Issuer has the right. So basically, who will be the victim? Investor will be the victim. Why you want to put this particular option? If you think that, if you have a sense that if interest rate will go up in the future, then you tend to do this type of additional condition. Only once we have seen this particular callable bonds. That was the long time ago. You must, I don't know, you may not remember the Vanik Incorporation. They have, the company is no more there. They have issued debenture with this callable option. But when you put a callable option there, since the investor is in trouble in the future at any time, so they are asking more. Their return has to be little more than the normal. Why? Sir? If I am an investor, I am taking a risk. Koi will make a recall price done. So then I am exposing to now, as an investor, I am exposing to reinvestment risk. I am exposing to interest rate risk. Now you know now these things. You as an investor, you are exposing to the risk. Which kind of risk you are exposing to? All these risks. Make recall when the interest rates have come down. So if you have money at this time, you will be investing at a lower interest rate. So all these risks are with you. Which risk? Which we have discussed now. Now you know. You know you perfectly all right. Now you have done everything. You have idea of what risks investor exposed. Right? So the callable option you have a way out, but very rare. Now instead of this, we have seen recently coupon is guaranteed. That's something else. Now callable option is there is for what? For you to protect. For you means who? Issuer to protect from the increase of interest rate. Issuer to protect. Now recently we have seen coupon rate is guaranteed by another bank. So if I'm not mistaken, when Ceylon was issuing a debenture, the Sampath Bank was guaranteed the coupon interest rate. There was a debenture like that. So that is something else. That is not the what you call interest rate or something related to, but the people who are going to invest in this particular Ceylon, they think that coupon interest rate will not be paid by the bank. So then the Sampath is a better image than the Ceylon, so they will guarantee. So there was a debenture like that, if I was mistaken. Right? So that is something else. That is now people should have a trust on you to invest. So we discussed how do you make the trust, how do you do the investor that we are capable of paying coupon plus the principal amount on the maturity, trustworthiness, who rated you, who rates you, rating agents. Rating agent. If your ratings little lower than the market, obviously you can be guaranteed by another recruiter. Okay. It can be also done, right? So that is that. And now remember this one, money market instrument, capital market instrument. Now capital market instrument we have treasury bill, money market instrument we have discussed the treasury bill. Repo is it's a type of product, plus for the short term, and treasury bonds we have discussed. Now what do you mean by shares? So we can finish off this. Now shares, of course, is the same thing. Only thing now the market, there is a market flow for us to take it share. Now only thing when you are proceeding later, there are investor related ratios. So the one thing is price earning ratio. Price earning ratio means how long for you to recover your investment. So when you are doing this project appraisal next, we'll be learning payback period. Same thing. How long for you invested your money? How long for you to take to recover that amount? Lower the better. ඉක්මනට මට සල්ලි recover කරගන්න පුළුවන්. I'm very good. Now, when you want to invest in share market, how do you take the decision? That's important to understand. කොහොමද මම ගන්නේ මේ share එකේ invest කරන්න ඕන කියලා? There are many factors to be considered. So the main factor is price earning ratio. So you like your investment to be recovered within a shorter period of time, right? So then the price earning ratio of this particular company has to be lower. There was examination questions, a 5-mark question, two types of share stocks given, and the two types of is A and B, and the price earning ratio also given. Price earning ratio, how do you calculate the price earning ratio? Market value divided by the EPS. So we'll be learning earning per share. We'll be learning later. Don't worry about it. For the time being, you just remember the price earning ratio. So basically, you go for the lower one. That you have to keep in mind. If you have to select one share out of several based on the price earning ratio, you select the lowest one. Why? You need, what do you mean by price earning ratio? How long for you to take to recover your investment? You like to go for the shorter one. So then the dividend yield and many ratio, investor ratios. We'll be learning. I'll give you notes on that for you to understand the later. So then now this market, share market, is basically we have two types of market: bull market and the bear market. Not tested this. Bull market is what? Prices are going up. That's the bull market. Bear market is going down. So we had bull market, we have bear market, and also remember there are two types of indices: all share price index and Milanka price index. Now recently the composition of the Milanka price has been changed. I'll give you what are the companies. There are 20 companies. S&P. I'm sorry, Milanka is not there. S&P. Now recently there is a difference. There is a change on the composition of S&P. Milanka was the previous one, right? They have renamed. Milanka is no more there. S&P 20. There are 20 companies which basically has the more market capitalization. What do you mean by market capitalization? Market share, market price into the number of shares issued. Market price, the number of shares issued. Now see this particular screenshot. This is the snapshot of one of the brokers. JB0 is one of the share brokers, right? There are 24, 28 brokers. There are many brokers for the share market, right? Now these are the companies. Now see, it have an alphabetical order. Bid ask. Bid means buying price. Now if you take this particular instrument, I don't know whether you can see this. I'm very sorry for the inconvenience. If you take Asia asset, somebody is willing to buy this particular share at 140 rupees. Somebody is willing to sell this particular share at 150. There won't be any transaction. If either you will have to come down as a seller at 140, either you will have to go up by 10 cents as a buyer. Now in this particular market, earlier we had every price movement. Now it's 10 cents. You can't put 19 22 you can't put. You have to put 10 cents. 19 20 30 then you want to buy at a lower rate. 19 20 then 19 10 19 18 like that. You can put it. You as a seller, you can have a 10 cents up. 1990 20, then you can put 20 if you want. If you want to sell at 20, you can put a bid, the selling bid at 20. Then now this guy has put 20 well, just this year shares look on he likes. If someone is willing to buy, he can. So here the highest traded price, lowest traded price, weighted average price, previous close, yesterday, total bids this much, total ask this much. Now see this particular asset, there are more buyers than the sellers. So generally what will happen to the share price? If you have more buyers than the sellers, obviously price should go up. It has reflected here now. Compared to previous day, it has gone up by 1 rupee. It has more. It has possibility to further go up. Now there are many malpractices relating to this, right? I'll be giving. When we are doing the questions, will be taking front running. What do you mean by front running? Now you have a broker. Now this is one of the brokers, JB Securities. You can have any broker. How do you open an account, CDS account? So you have to go. There is an app now. You have to speak to the dealer. There is a SEC app. You can download onto the phone, and then you can proceed. And there you are given the list of brokers you can select. Then the following day the broker will call you. That's how it happens. Right now, so everything is automated. Right? Common information they are asking. Then you have been given the option to select this guy, the broker as well. Right? Now, what do you mean by front running? You have a broker. You are given. You are giving a, what do you call this? You are giving an order. Now, this example of Asian Alliance. Asian Alliance shares mang dinawa ganna kiyala wala laksa 5. So what happens is broker goes and purchase for his own account, which is completely prohibited. Mini aragena මොකද කරන්නේ? මිනිහා කියලා තමයි මට හිතුණා. Front running. Insider dealing. Tested for 5 marks these things. Huh? Insider dealing. What do you mean by insider dealing? Undisclosed price sensitive information. So when you're working in example, now HNB is a share, the listed company. So working in a bank, listed bank, who gets the information first? Is it you as employee? No, you are not. You may be the third or fourth, but board of directors, the members of the board of directors getting the first-hand information. So what happens is, if now, for example, now say HMG is going to be merged with another bank, which is not to be disclosed at the moment. It's only a plan only. They have not decided, they haven't structured. But you as a director, you know that you go and purchase HMG shares, thinking that you can sell at a higher price. Insider dealing, criminal offense in Sri Lanka. Undisclosed price sensitive information. Right? Pump and dump, another malpractices. Now you must have, if you are on the, if you are an investor of this particular shares or the share market, if you are investing in share market, then you will see that no worth of this particular company, but share prices are moving on. Have you seen? Recently also we have seen, and there was a investigation also started by SEC, unusually price movement. What happened? Samanya share quotas. Api Samanya as Sri Lankans, we definitely, when the share market was at lower, when the prices have come down, when the ASI, all share price index have peak, we are not buying. Samanyen api share prices adu වුණාම ගන්නේ නැහැ. අපි ගන්නේ සාමාන්‍යයෙන් කොයි වෙලාවෙද? වැඩි වුණාම වැඩිම රේට් එකකින් තමයි ගන්නේ. වැඩිම amount එකකින් තමයි ගන්නේ. සාමාන්‍යයෙන් that's a culture. හැබැයි ඒව ගන්න අය ඕන තරම් ඉන්නවා පල්ලෙහා prices වලින්. පල්ලෙහා prices වලින් අරගෙන වැඩි වුණාම විකුණනවා. So what happens is you get together. We have 3. You purchase. So we 3 purchase together. When you have more purchases, now similar to this Asian Airlines, you have more bids than the ask. Ask means selling, no? Bid and ask. When you are doing this proprietary trading, we'll be having exchange rate, bid and ask. Same thing. Bid means buying, ask means selling. Now here the selling is lesser than the buying. सामान्य supply එක අඩු නම් demand එකට වඩා obviously price should go up. So then you purchase and I also put bid. Everybody is putting bid. Then the prices should we three taking this price up. ඔයා මට විකුණන මම ඔයාට විකුණනවා like that. So we as an innocent investor, you as an innocent investor thinking that මේක හෙටත් උඩට යයි. Then you enter into this and you purchase it. What happened? Tomorrow they will withdrawing their purchase. So what happened? You have purchased this particular share at a highest level. You are keeping it. There is no value in this particular company. So there is no possibility to go up the prices as well. So there are many people, many investors like that, innocent investors like that. When we had that after the civil war is over, 2009, we had a market like this. And I told you in the first lecture also. Today we purchase and you can select keeping a 10 rupee profit without paying anything. So T plus 2, T plus there is a mechanism for you to pay. You don't have to purchase. If you purchase it today, you don't have to pay it. Now recently they have introduced this DVP method, not implemented it. I'll also upload some note on that DVP method as well, right? So share market is so basically CDS account is what? That is your account. Now these are scriptless, right? When you make investment, you purchase shares, you don't get anything. How do you get to know? There is an email message that coming from the broker that you have purchased this much. This is your outflow. This is one, and end of the month, every month you are getting a CDS statement. These are the investments you have made. These are the investments you have made. These are the quantities you have purchased. These are the quantities you have sold. That is statement you are getting. Otherwise, scriptless, right? There is no statement. And if you have make an investment in this particular company, you don't get a share certificate. No. Scriptless means that there is no paperwork. Okay, paperwork. And now, what are the shares we are buying from this market? There is no preference shares trading. No? Only the ordinary shares are trading. Why? Anybody who is purchasing, anybody who is investing in ordinary shares are the true owners. True owners. True owners. So basically here there are two types, voting and non-voting. But the entitlement to everything is similar. Only thing the difference is you can't vote if you are investing in non-voting shares. That's all. At the AGM, at the annual general meeting, you can't vote. That's the only difference. If you are making investment in non-voting ordinary shares. Now these are ordinary shares only, right? These are ordinary shares only. So there are basically there are, when you have a relationship with one of the brokers, they send you reports, investor research report. You have another topic called investor research. So that is broker is also the similar, right? Brokerage is similar. So basically they are giving, if it is a particular company, they are giving a research report for you to understand these are the potentials, and they are giving you the recommendation as well. Either to buy, either to hold, either to sell. That's the three options will are execute. Ekko shares ගන්න ඕනේ, ekko shares විකුණන්න ඕනේ, නැත්නම් තියෙන එක hold කරන්න. So for you to take out of three decisions, they are sending you research report. So in research report, they are recommending for you to hold, they are recommending for you to buy, they are recommending for you to sell. There are recommendations like that, right? Now, particular, now this one, investment advice. Investment advice are given by who? Share brokers. Share brokers. And also investment research and security analysis. Also, they are sending you the report only, right? It's a report basically. If you take one come don't just they are sending you a report. They are analyzing it. They have researchers. They are sending you the report, right? So basically, some are literal meanings only. So that's why I told you, right? Some are literal meanings only, right? So ordinary shares only we are purchasing, either non-voting, voting, and share market, there are requirements for you to be listed. We have several boards, main board, D07 board, MCB board, and Empower board, right? So I'll be giving a note on this, and also the listing requirements have not been changed. I'll give you that note as well for you to understand. Any question? So basically, I thought of I will inform you to finish this off, and I'll be taking an extra class of with you all. I'll let you know the date rather than taking one session at a longer period. Now they are asking there's an option for us to take 7 to 10. So I will not generally taking the entire 2 hours. I'll be finishing before that. Rather than taking that, I'll sort of giving a fresh new 1.5 hours time or 2 hours. I will let you know. Then we can finish. So since your exam has been advanced, basically it was scheduled to be held in November. Now it has advanced to end of October. So basically we'll be losing kind of lecture sessions that we need to catch up. So that's right. So but this is ideal time for you to sit for the exam. So everybody knows, the examiners also know the difficulties you are facing. Now this online learning and online teaching is not that much effective. Not that much effective. So everybody can understand. So basically your papers also will be not that difficult. Now last session paper also not that difficult. People have pass mark was quite high, yeah. Pass mark was quite high. Pass rate was quite high in Sri Lanka. So then, so we will be taking that as well, and I want to discuss with you the past paper as well. I'm recommending you to take this previous papers with you. So we basically, since I have finished this government security part, fixed income security, I can take this. Only thing I have to take this right issue pricing here, right issue pricing here, and the clean price, dirty price, which is there's a calculation also involved. I'll do that for you, and I'm requesting you to purchase this particular. Keep it with you. If you can get a photocopy, that's fine. Keep it with you. The past papers. Now we'll be starting. Then I can show it to you. The amount we have discussed here, how the examiner has tested so far, based on that. Any question you have before we wind up? So anything you need to clarify? Only thing I think it is better for you to start your learning now is the exam has advanced rather than waiting for the last moment. So I'm requesting you to start it now. You bring, if you have anything you need to discuss at the class, bring it to us. So then we can discuss further, right? So keep it with you, the past paper ready. So we'll be discussing past paper as well now, right? So we hopefully I will be taking an extra class basically in the evening only, right? So probably I will discuss with Kavindra and I'll let you know if we have this session this week. So then we can finish it off this one, right? So since you don't have any questions, so we'll wind up the class. Thank you very much.